Welcome back to Market on Close. Time for big picture discussion. Joining me, Collin Martin and Kevin Gordon, here to talk bonds and stocks. Kevin's a senior investment strategist, and Collin's a director and fixed income strategist at the Schwab Center for Financial Research. Mr. Gordon, get us started. What in your mind is it going to take for us to punch through those all-time highs? We keep getting so close, but slipping just before them.
Confluence of factors. I mean, I'd probably put anything policy related coming out of Washington at the top of the list. Not as much, specific meat on the bones for an actual dollar amount for tariffs or any specificity around immigration policy, but I think some sort of smoothing out with regards to how this process goes. Because if it's one thing that we learned from, the 2018 to 2019 trade war period with China, which at that time, importantly, only involved one major country. Now you're involving potentially, a whole block of countries around the world. I think just the nature of how policy is made, you probably need to see some easing there. It's not that we can't rally, in perpetuity as long as this is how policy is made. It just makes it, a little bit more challenging of an environment to operate in. Especially when you don't have as much of a helping hand from the mega caps. And that's been, I think, a notable theme, year to date, but also you could kind of almost date it back to some extent, last June, when you look at a sector like tech, hasn't moved much since last June, specifically, a huge component of that, semiconductors, is sort of the chief offender there.
Love that point, chief offender. I might borrow that from you, as those have been stuck, going nowhere. And just when it looked like they were going to break out, we had the DeepSeek thing, and they gave it back. So definitely a big point of the market here. The other thing, though, that might be working for bulls is that the bond market's been pretty quiet, Collin, and for the most part, generally equity folks like to see that. Do you see any disturbances underneath the surface with inflation readings coming this week, Collin?
I mean, right now, the treasury market's behaving really well, as you alluded to. It's been a pretty wild start to this new administration. We've seen a lot of ups and downs with the stock market, but the treasury market's hanging in there. We're seeing yields kind of steadily decline over the past few weeks, which is, you could argue, a bit surprising because a lot of the policies that we see on the horizon potentially being inflationary, but that hasn't worked its way into the bond market just yet. But we're also seeing a lot of calm in the broad parts of the bond market, not just treasuries, but if you look at the credit markets, really no signs of concern there. So we're kind of stuck in this range right now, but we do think the risks are tilted to the upside. It all comes down to inflation, so we're going to be paying attention to the CPI and PPI reports coming up this week. But inflation is proving to be a little bit sticky. The Fed's likely to be on hold. And if we start to see that stickiness continue or maybe move a little bit higher because of, say, tariffs or immigration changes, things like that, we think that leaves some room for treasury yields to move higher, especially at the long end.
Okay. And when you're looking for that, does that involve steepening, I assume, Collin? Because we've been flattening out a little bit now for the last couple of weeks.
Yeah, it'd probably come from steepening of the yield curve. Short-term rates are probably going to stay range-bound for the time being because we don't expect any moves by the Fed. They're likely to stay on hold for the next handful of meetings, handful of months, and we still think the next move is likely to be down as opposed to up. We're not talking about rate hikes just yet. So if you get those short-term yields kind of anchored where they are around 4.25%, and we get to see a drift higher long-term yields, then we think it'll be more of a bear steepening effect with that long end of the curve.
Okay. So, Kevin, to bring it back into stocks, then, as you know, I like to do kind of the hypotheticals ahead of a print. Do you think that stocks have a decent buffer for bonds right now, given that they've been pretty calm? Could we get a little bit more of that steepening back in the forefront without equities freaking out?
I just think it depends on, ultimately what's going to drive it. And, to Collin's point about sort of the potential moves for something like the 10-year or whatever you want to use, on the curve, I think what's going to be really tough from a policy standpoint this year, and, typically we wouldn't factor policy in as much, but you're talking about, really potentially extreme and aggressive moves for trade, but also for labor. And I think that what's tough about this scenario, both for the bond market and the stock market, because they are, to the points you both have been making, somewhat tied to the hip here, is the fact that you could potentially get a pretty significant inflationary boost from both of those policies, or both of them combined. But then you could also get a relatively significant hit to growth. I could see a hit to growth scenario for tariffs if they're put on in a rather extreme fashion, and then that causes more of a suppressant on business capex, but also in turn consumer spending. But even from a labor standpoint, if you are taking out a relatively large chunk of the labor force and or curbing immigration, into the country, and then you don't have sort of that one-to-one replacement for the workers to be replaced that are taken out, and you don't have that aggregate demand, then you have a pretty significant hit to growth as well. So I think that's the tough thing from the perspective of the bond or the stock market, but also the perspective of the Fed in trying to assess, yes, there may be a boost to inflation, but what comes after that? And that's I think the sort of murky environment we're probably going to be in for a while.
Yeah. Well, we'll get a fresh update here coming up 2 days for CPI, kind of the highlight of the week. So we'll revisit then. Appreciate it, guys. Thanks for the setup.